Just a quick question. Have you ever noticed your mortgage payment suddenly jump? Or your car loans getting more expensive out of nowhere? Chances are, you didn't do anything wrong. It's just the central bank just raising its interest rates. You've probably seen the headlines. The Federal Reserve raises interest rates again. But what does that actually mean? Why would a central bank want to make borrowing more expensive for everyone? Isn't that just going to hurt regular people trying to buy a house or a car? Well, believe it or not, raising interest rates is actually one of the most powerful tools the central bank has to keep the entire economy in check. In this video, we'll break down what interest rates really are and why central bank raises them, and how it actually affects inflation and whether this whole strategy always works out the way it's supposed to. Now, let's get started. Chapter 1. What is interest rates? Before we talk about why central bank raises interest rates, let's quickly break down what interest rates actually is. Simply put, an interest rate is the cost of borrowing money, or the reward you get for saving it. Let's say you borrow $100 from a friend, and they tell you, sure, I'll pay me back $105 next month. That extra $5 is basically interest. It's the price you pay for being able to use someone else's money right now instead of waiting until you have your own. Banks work the same way, just on a much bigger scale. When you take out a loan, whether it's for a car, a house, or credit card, the bank charges you interest, a small percentage on top of what you borrowed. That's how banks make money, and it's also the cost you pay for borrowing. But interest rates work the other way too. If you put money into a savings account, the bank pays you interest, since you're essentially lending your money to the bank, and they reward you for it. So in short, interest rates affect almost everything financial: borrowing, lending, saving, and spending. And when the central bank decides to raise or lower interest rates, it doesn't just affect one loan or one bank. It ripples throughout the whole economy as all the banks have to adhere to the decision of the central bank. So for example, if the central bank decides to raise the cash rate, essentially another term for interest rates, all the commercial banks must then raise its own interest rates proportionally to match the increase in the cash rates from the central bank. And this is exactly what we'll dive into next. Chapter 2. Why do central banks raise interest rates? Now that you know what an interest rate actually is, let's talk about why central banks decide to raise it in the first place. The first, and probably the biggest reason, is to fight inflation. Remember, inflation happens when prices rise too quickly because people are spending and borrowing a lot of money. When a central bank raises interest rates, borrowing becomes more expensive, so people think twice before taking out loans or swiping their credit cards. At the same time, saving becomes more attractive since banks now offer better returns on saving accounts. As people borrow less and save more, spending slows down across the economy. And when people spend less, businesses can't keep raising prices as easily, since demand starts to cool off. This is exactly how raising interest rates help bring down inflation and back under control. The second reason is to cool down an overheating economy. Sometimes, an economy grows so fast that it actually becomes unstable. Too many people are borrowing, too much spending, and prices are rising out of control. It's a bit like car engines running too hot. Raising interest rates acts like hitting the brakes gently, slowing things down before the economy overheats and crashes into a bigger problem, like a recession. The third reason is to stabilize the country's currency. When a central bank raises interest rates, it often makes that country's currency more attractive to foreign investors. You might ask why. It's because investors can now earn higher returns by keeping their money in that country's banks or bonds. As more foreign money flows in, demand for that currency increases, which can help to strengthen its value. The fourth reason is to manage employment and wage growth. When the economy is doing really well, companies compete hard for workers, pushing wages up quickly. While higher wages sound great, if they rise too fast, businesses raise prices to cover those costs, which can add fuel to the inflation. By raising interest rates, central banks can slow down the cycle, keeping wage growth at a more sustainable pace. So in short, central bank raises interest rates mainly to fight inflation, cool down an overheating economy, stabilize the currency, and manage wage growth. But like most economic tools, This comes with some pretty serious trade-offs, and that's exactly what we'll look into next. Chapter 3. How raising interest rates actually slowed down inflation. So we know raising interest rates is supposed to slow down inflation, but how does that actually play out in real life? Let's break it down with a simple example. Imagine a young couple called Alex and Jamie who've been saving up to buy their first house. Interest rates are low, so mortgage payments are affordable and banks are practically begging people to borrow. And now, encouraged by the cheap borrowing cost, Alex and Jamie take out the loan and buy their dream home. Meanwhile, their neighbors are doing the same thing, and so is almost everyone else. New loans are taken out left and right, whether it's for homes, cars, or even just everyday credit card spending. With so much borrowed money flowing through the economy, people have more cash in hand, so they spend more. Restaurants are packed, stores are busy, and businesses raise their prices since everyone is willing to pay more anyway. This is exactly the kind of environment where inflation starts to creep in fast. Now, the central bank steps in and raises interest rates to cool things down. Suddenly, that same mortgage that Alex and Jamie were considering becomes more expensive. Car loans cost more too. Even carrying a balance on a credit card gets pricier. Naturally, people start to borrow less, since loans are just not as attractive anymore. At the same time, saving money becomes more rewarding since banks now offer higher interest on saving accounts. So instead of spending everything right away, more people choose to save instead. With less borrowing and more saving, people simply have less cash floating around to spend. Restaurants get a little quieter, stores see fewer big purchases, and businesses can't keep raising prices as easily since customers are more cautious with their money. Demand slows down, and so does the pace of rising prices. And that's basically the whole point. By making borrowing more expensive and saving more appealing, central bank pumps the brakes on spending across the entire economy. Less spending means less demand, and less demand means inflation naturally starts to cool off too. Chapter 4. Real-world examples. A recent but famous real-world example happened between 2022 and 2023, when the US experienced another wave of high inflation, this time triggered largely by the aftermath of the COVID-19 pandemic, supply chain issues, and massive government stimulus spending. In response, the Federal Reserve once again raised interest rates aggressively, taking rates from near 0 to over 5% in just about a year and a half. And just like before, the cost of borrowing shot up fast. Mortgage rates doubled, and many businesses slowed down their expansion plans. Inflation, which had peaked over 9%, gradually cooled down over the following months. However, this also made life harder for everyday people, especially those looking to buy homes, as higher mortgage rates pushed monthly payments up significantly. Chapter 5. Conclusion. So in conclusion, central bank raises interest rates mainly to fight inflation, cool down an overheating economy and stabilize their currency. It's a powerful tool, but it's definitely not a free one. Higher rates can slow down growth, increase unemployment, and make everyday loans more expensive for regular people. And if pushed too far, they can even tip an economy into a recession. So really, raising interest rates is a constant balancing act. Central banks have to walk a fine line between controlling inflation and avoiding too much economic pain. Getting that right balance isn't easy. And that's the end of the video. If you'd like me to make more videos explaining topics like this, please like and subscribe and leave a comment on what you'd like to see next. All your feedback and support truly help the channel a lot. Thanks for watching.